Alright guys, welcome back to episode 2 on the Ictfinatic 2025 mentorship. Let's get straight into it, and obviously this mentorship, we are not wasting any time or waffling on about stuff that you guys don't even need to listen to or need to know. We go straight to the facts that's actually going to make you the money. So taking a look at the first slide, understanding liquidity. This whole episode is going to be based on liquidity and understanding high probability liquidity levels, and also liquidity levels which are not really that important and likely to get ran through and continue in that direction, because not every point of liquidity which has been swept, it's not always a sweep and a reversal. Usually majority of the time it can actually be a continuation towards the actual draw of liquidity. A random minor sell side or minor buy side is not actually always going to cause a reversal in price. Liquidity is the fuel for majority of major moves in price. So usually when you see a major move in price, 200 to 300 handles on NQ, if you look before the move has happened, usually a major point of sell side or buy side liquidity has been taken prior to that move happening. Because initially what happens is that price would seek a point of sell side such as London lows, Asia lows, or higher time frame equal lows. For example, once price has taken these major points of liquidity, then institutional interest is in place, and this is when you see that inject of liquidity for price, and you see that shift in market structure which initially causes that move in the opposing direction. Not all liquidity grabs lead to reversals, and this is one thing that I mentioned just a couple minutes ago. Just because price has swept London lows does not mean that it's going to continue back towards the New York Open price, or it's going to continue back to a point of buy side. For example, price can sweep London lows, but the overall draw for price is still lower. And this is one thing that you have to understand when you are monitoring price, and not just simply looking at it blindfolded and thinking liquidity swept, now let's look for longs. You always have to zoom out of the lower time frame onto the higher, understand where that next 4 hour and the daily is likely to draw to. It swept London lows, okay, but what about Asia lows or previous day low? Maybe we have points of sell side where price is likely to draw to in order to meet the objective before going back in the opposing direction. So yeah, context matters for when you see a sweep of liquidity. High probability liquidity points to monitor inside of the New York AM session, the lunch macro, also the PM session, and inside of London. So we have points of equal lows and equal highs. For example, these are two levels in price which are very close, around the same price point. So you'd have a high at 20,000 on NQ, and then at 19,990 you'd have another high on NQ. That would be a set of relative equal highs, and ES does tend to make equal highs more often than NQ, just due mainly to the way that ES moves. But however, on NQ you would have a set of relative equal highs which price is always likely to draw to. Equal highs, equal lows, or major points of liquidity in price is where majority of stop losses accumulate around that level, and this is always why price continues to draw back to these levels. Due to natural human traits, the way price operates on a day-to-day basis is never going to change. I've seen people comment on other YouTube videos which are to do with ICT. They are asking whether this strategy is ever going to stop working, and the simple answer to that question is no, mainly due to the fact that basic human traits of going short at points of supposed resistance and also points of supposed demand where people are going long, stops always accumulate around these levels, and this is why price moves the way it does, simply due to natural habits of people taking trades. And obviously retail traders only actually accumulate around 5% of the daily volume which you see on Nasdaq on a day-to-day basis, only 5%. The other 95% is to do with mostly institutional interest, and this is one thing to identify, but you don't need that much point of liquidity below sell side or buy side liquidity in order for price to move. Even one contract on NQ above that level can draw price towards sell side, and that would be the overall draw where institutional interest would then be placed, and then that's when you see that huge move in price. So as long as you understand where institutional interest is likely at, such as order blocks and points of liquidity, because we don't enter with institutions enter, and then we understand what has happened, and then we capitalize on that opportunity to target the opposing opposing liquidity. Points such as previous day high and previous day low. So within the window of when the market opened and the market closed, this is going to be your previous day high and previous day low. You also have previous week high, previous week low, and also previous month high, previous month low. These are all points of liquidity that you're going to look to mark out on a day-to-day basis. So when you do approach the London or the New York Open, you're going to want to mark the previous day high and previous day low and understand whereabouts they are in price, and is price likely to draw to this level. You don't always have to be 100% correct, but you want to understand where price is likely to draw to, preferably on the 4-hour time frame. This is one thing that's very important. If you understand where the next 4-hour candle is likely to draw to, then you're going to have more of a clear directional bias when you approach on the lower time frame inside of the macro. Because if your higher time frame bias is incorrect and you approach on the lower time frame, then you're most likely going to get faded out for your incorrect higher time frame bias. So key levels between London and the Asia session. Asia runs from 8 p.m. to 2 a.m. and London runs from 2 a.m. to 5 a.m. So between these time windows, you want to mark out any previous highs and lows between this session. This is mainly important for the New York session. So when you are trading the first AM and second AM macro, you're going to want to look to mark out these key liquidity levels inside of that macro and either look to target these levels or look for these levels to get taken out in order to target the opposing liquidity. And then discussing new week opening gaps and also new day opening gaps. So between the closure of the New York session at 6 p.m. and the new opening of the new day, then the new day opening gaps is one thing that price always 90% of the time draws to that level within that week. And also the new week opening gap around 90% of the time, price within that week, it would actually look to draw at least the 50% range of the new week opening gap and before making another move. So it'd either inverse the new week opening gap or it would go to around 50% range and then continue back in the same direction it was already going. So these are two key draws on liquidity: new week opening gap and new day opening gap. They act as magnets for price to draw to within that week. And then, as you guys probably already know, data highs and data lows are major draws on liquidity as well. So when you have red folder news at 8:30 a.m. and 10 a.m., then price would likely wick all the way up and it would wick all the way back down, and these are going to be your data highs and data lows. So for example, CPI comes out, it's up 200 handles, then the high of CPI on the 1 minute time frame, that's going to be your data highs, and the low of that candle is going to be your data lows. And if it's already been taken out and you're approaching the AM session in New York and data lows has already been taken, then automatically you're going to be leaning towards more of a bullish bias. And obviously taking a look at other points of interest and other context, because you can't just say data lows has been swept, we're going to look for longs. But with other context in place, then you could work out an overall bias and see whether longs actually fits that current scenario. So as we've already discussed, a sweep of liquidity does not always stand as a reversal in price. It doesn't always mean that price is going to head back in the opposing direction. So trades taken after a sweep of liquidity must have many major confluences in order to take the trade, such as higher time frame imbalances, which we're all going to go over inside of this mentorship, breaker blocks, mitigation blocks, SMT, market structure shift, and obviously a lot more. And I can't note everything down right here, but we're going to be going over absolutely everything that you need to know inside of this mentorship. So what we're going to do now, guys, we're going to jump into a breakdown live on the charts, because I know that's exactly what you guys want to see. I'm going to show you guys an AA plus setup. This is super clean, the cleanest setup that's formed this whole year. In fact, this is a trade that we caught ourselves and ran straight towards final TP. Super clean trade, lovely stuff. Let's get straight into it. Alright guys, for example, let's take a look at price. This is inside of the second AM macro, which is at 10:45 AM to 11:15. So we're going to wait, and we are prior to the macro at this point around 10:30 AM, and we have a clean draw for London highs and a point of sell side which has the New York opening gap. This is also a major draw in price. So you can see here at the New York Open we have this unfilled New York opening gap. So price at the New York Open has created a fair value gap which is currently unfilled with a lowest point of sell side which rests just above it. So if we do get a clean sweep of London highs and tap into this unfilled 4-hour bearish gap, as you can see here we have an unfilled 4-hour bearish gap on NQ and also a unfilled 4-hour bearish gap on ES. We have a clean draw for London highs on NQ, as you can see, and obviously that point of sell side with the New York opening gap. So let's monitor price inside and prior to this second day macro and see if we get any clean opportunities. Okay, so one thing that I'm going to mark out here is that we have a lower time frame short-term high, and we also have a short-term high on NQ that has just been taken as well. So price has tapped London highs at this point, but it's not quite taken it. I believe it might have taken it by one tick, but I want to see just one more sweep of liquidity in order for price to actually displace lower. If we was to displace lower at this point, we would displace below this short-term low for price, and this would be our bearish breaker. We are going to get into breaker blocks, mitigation blocks, and identifying the correct ones and the most high probability breaker blocks to use in order to take a trade on price. But that's going to be later inside of this mentorship. So for those of you that don't understand what a breaker or a mitigation is, we are going to deeply go over that inside of this mentorship. Okay, as you can see here, we've actually taken out this point of London highs very cleanly. We've also tapped into this unfilled 4-hour bearish gap resting above, and as you can take a look on the 15-minute time frame, what do you guys notice who are possibly a little more experienced with ICT? What do you notice between NQ and ES with London highs? You guys can pause the video or just take a little 10-second break here and identify one thing that's a major confluence right now for shorts on ES. So if you haven't noticed the difference between NQ and ES, you can see that NQ has taken London highs and ES hasn't. Therefore, we have a bearish SMT on ES, as ES has not taken that point of buy side, which is actually a confluence for ES as the weaker pair out of the two. So there we have it. We have so far a bearish SMT. That's one thing that you would look to mark out on ES, and also that's a confluence for NQ for shorts. It's likely that NQ is going to draw lower if ES actually has a bearish SMT. And when we look for this displacement lower for price, we want to see it correlated between NQ and ES. So we want to see the displacement lower on both NQ and ES, not just on NQ. If ES doesn't displace, then we're not going to take any trades. So let's monitor price inside of this secondary macro and see whether we get any clean opportunities for shorts. Okay, so as you can see here on the 1 minute time frame, we've actually created this short-term high for price, and this means that this would be our mitigation block. So there has been a failure to take out the short-term high on both NQ and ES, and our mitigation block would actually be on ES. You can see the wick of this candle is going to be the low of the mitigation. So our mitigation is paired with this fair value gap, and at this point ES has displaced below this short-term low for price. Therefore, this is a very high probability fair value gap in order to enter off. We have a mitigation paired with that fair value gap, and we've also displaced lower on ES. So already I'm seeing a very clean opportunity for shorts on ES, and now we're also inside of macro. If you take a look at NQ, there's actually no opportunities just yet because we do not have a fair value gap that has formed. Okay, so as you can see here, we have a fair value gap formed on NQ. So we're going to look at this first presented fair value gap on NQ, which is our first point of entry. When a clean opportunity does form in price, you're always going to want to look to take the first point of entry. So that first fair value gap or breaker block for price. You only enter off a breaker block as long as a fair value gap has already been presented paired with that breaker. If you have a breaker paired with that fair value gap, that is our unicorn model. And if you can't get an entry off that fair value gap, it's not a problem. However, if you do enter off an upper fair value gap, that is going to be the fair value gap you're going to want to look to enter off, as long as your stop placement is minimum at the low of the displacement candle. So the candle that originally caused the displacement, you want it to be at the high or the low, depending on whether you're long or short. So considering you're short in this scenario, this is the displacement candle. So at a bare minimum, you want your stop loss to be at the displacement candle's high. And for example, in this scenario on ES, this would not be a valid scenario to run a stop at this level because our mitigation block is here. So all PD arrays, you want to make sure your stop is above. So all bearish PD arrays for this example, a valid stop would be at 6045 on ES. And for example, on NQ, you'd want to run your stop around at least the 397 level in order to make sure that your stop placement is actually valid. So a stop placement around this area would be valid. We have this bearish order block for price, and you want to make sure it's above the last point of PD array for price. So also taking a look on the 2 minute time frame, we have a 2 minute bearish breaker block, which is paired with this 2 minute bearish fair value gap. This is a very clean example of a bearish uni on the 2 and also the 3 minute time frame, where we have a breaker block block paired with that 1 minute fair value gap. So a 2 minute bearish breaker paired with that fair value gap on NQ, super clean opportunity. And as you can see here, price has actually come back up to this fair value gap. It has tapped the edge of that fair value gap and it has filled you short at 10.49. So you would have entered short at 10.49, obviously running your stop around 397 area. And guys, I really hope this breakdown is somewhat making sense. Obviously we have a higher time frame bearish SMT for ES, and as you can see, we've tapped into that 4-hour bearish gap resting above London highs. We've seen a clean displacement lower and a 2 and 3 minute bearish breaker paired with the 1 minute fair value gap. So the mitigation on ES on the 1 minute paired with that fair value gap, which is a super clean opportunity for shorts. So this trade example is an A+ setup and it's a 1 to 5 risk to reward of this fair value gap. So let's take a look and see how this trade plays out. This first point of sell side is going to be the overall objective. So I actually recommend you take your full TP off at 137, but for this trade example, I'm going to take my full TP off at 163, and I'm taking 80% of my position off at this point of sell side and run a further 20% to that point of sell side, which has the New York opening gap resting below. So as you can see here, created an internal range liquidity for price. So there's a possibility that either NQ or ES would look to take out this short-term high, where a lot of positions would have actually trailed their stops to this short-term high already. And this is not something that I would do. I would only trail my stops once price actually takes the first objective. The first objective is going to be this short-term low. So this point of minor sell side, which is in a discounted range of this move. So using the Fibonacci retracement tool, from the low of this move to the high, obviously you want to find where price would be in a discount. A discounted point of this range would be this minor point of sell side where this short-term low was created. Once price takes out this short-term low, then you're going to trail your stops to break even, and it'll be a completely risk-free trade from that point onwards. Okay, so one thing that you've actually seen here, if you actually zoom in to NQ, so you can see that NQ did not take this internal range liquidity, and on ES actually took the internal range liquidity. Therefore, we actually have a bearish SMT on ES, we have a bearish SMT on NQ. Therefore, NQ, for this example, is the weaker pair out of the two. And this is the final confluence that you overall needed on this trade to make it a full textbook trade. I mean, this is literally the cleanest trade I've seen the whole year. This is why I'm using it as an example inside of this breakdown video for episode 2. So we have a bearish SMT now for NQ. As you can see here, ES took out that short-term high, so buy stops is what rests above internal range liquidity. So people who set their stops to that previous short-term high have now been taken out on ES, but not taken out on NQ because NQ is now marked as the weaker pair. Okay, so for this example, we've actually created a short-term low. As price went towards internal range liquidity, we created a short-term low for price. And once price does take this short-term low, I'm actually going to move my stops to break even. So this is going to be our point of break even now for price. So when price does take that short-term low created, then you're going to look to move your stops to risk-free at around break even. In fact, you can always move your stops to the previous short-term high, which is recommended, but for me personally, I always move my stops towards break even once that short-term low has been taken. And you can actually reference this as a first TP area or a point to trail your stops aggressively, but I'm not going to be personally taking TP at this level, and I only take TP once the objective has been met. So I set my stop and I trail my stops along the way of the trade. Once points of liquidity have been taken, I trail my stops more aggressively, and then once price does take the final objective, then we take the rest of the trade off. So one thing to understand about taking partials and take profit on a trade is that once this point of sell side liquidity has been taken on ES, you're going to want to fully close out of your position, because once ES does take this low, then that's going to be your final TP, for example, taken already on NQ. And ES is the main asset that you look to monitor. Whatever happens on ES is likely to bring NQ in the following direction. This is the major asset and it's the stronger asset out of the two. It's the one that dictates where NQ is basically to go. This ES is more of the father-like figure out of the two pairs. ES will usually dictate where NQ is likely to go. So once ES does take sell side, that will be a bullish SMT for NQ, so you're going to want to be out of your position. So now price has now taken that short-term low. I'm going to trail my stops towards break even. It's a completely risk-free trade. So as you can see here, we created a bearish fair value gap here paired with this mitigation block on NQ. So every bearish confluence for price should get respected all the way towards that point of sell side. And as you can see here, we've actually taken out the first objective of a discounted sell side liquidity for price. And at this point, I would not trail my stops any more aggressively than I already have. I'm going to leave it at this point. Once price creates two short-term highs, then I can further trail my stops in that following direction. Okay, so as you can see here, this is a point that I would actually trail my stops straight to 21,291. Price has now taken out this short-term low for price, and we're very close to this point of sell side. Therefore, I expect price to draw straight to this point of sell side immediately without returning back to this short-term high. So my stop is now going to be trailed at this previous short-term high. And there you have it. So that point of sell side on NQ has now been taken. I'm going to be taking 80% of my position off at this point of sell side and leaving the rest of the position and the stop at that short-term high. So I'm 80% out. I've only got 20% of my position left in towards that other point of sell side. And we also have the New York opening gap, which is unfilled, resting below sell side. So I still expect price to draw to this point at 203. And obviously, once ES does take that objective of sell side, then regardless, I'll be closing out my position fully. And there you have it. So ES has taken sell side. At this point, I would close out of my position fully, and that's 148 handles secured, which is around a 1 to 4.8 risk to reward on that trade. So a very clean example. And now we are going to go over marking out key liquidity zones at the New York Open in order to identify where price is likely to draw to and what liquidity levels are high probability for the New York AM session. Okay, so taking a look at price on March 10th on Monday, we're going to be marking out the key liquidity levels on the 15-minute time frame. I always advise you mark out your key liquidity levels on this time frame because it's very easy to identify the highs and lows between the London and the Asia, and also taking a look at previous week low and previous week high, previous day high and previous day low on the 15-minute time frame. It's also very important looking at the 4-hour time frame to understand where the next 4-hour candle is likely to draw to. And for this example, there's little to no context to understand whether we're going to draw lower or higher. We have a bearish gap. However, we also have the previous week low, which rests at this point as well. Therefore, I'd actually approach this AM session leaning towards more of a neutral bias, considering that the 4-hour could either draw back into the 4-hour bearish before drawing lower, or it can actually draw straight towards previous day low. So I'd approach more with a neutral bias inside of this macro, but leaning towards more of a bearish bias. So I'd prefer to take a bearish opportunity for price. If a very clean long opportunity is presented, then I'd still look to take it. As you can see from the previous week, this is actually the previous week low which was created. So you're going to want to mark out the previous week low on both NQ and ES, and then obviously between 8 p.m. and 2 a.m. this is your Asia session. And as you can see here, the high created inside of Asia session has actually left a pair of relative equal highs. So this high and this high never took out this one. Therefore we have two sets of highs on NQ which is relative equal Asia highs. So you're going to want to mark that out ready for the AM session. And then between 2 a.m. and 5 a.m. this is going to be your London session. So you're going to want to mark out London highs and London lows. For this example, London lows has already been taken, so there's no point in actually marking that out. But we do have a set of London highs which is actually paired very, very close with Asia highs. So for price to draw to this level within the matter of this week is actually a very high probability that price would look to take out these points of liquidity. And for example, discussing the new week opening gap, as you can see here, from when Friday closed at 5 p.m. and then reopened on Sunday at 6 p.m. of the futures market, we have the new week opening gap. It's a very high probability point that price would look to draw to within that week. And considering that's paired with these equal Asia highs and London highs, I expect price to actually draw towards this level here. So obviously taking a look at the differences between NQ and ES during the Asia session, NQ is obviously the weaker pair going into the New York Open because we have a bearish SMT for NQ, and ES took out this point of buy side liquidity during the Asia session, and NQ did not take out that point of buy side. Therefore, bearish SMT for NQ inside of this AM session. So likely price could continue very easily to draw to that previous week low. But apart from marking out these key liquidity levels, there's nothing else for you to do apart from monitor on the 1 to 5 minute time frame inside of the first day in macro and understand where price is likely to draw to. And one thing that you can do here is also marking out minor points of buy side and sell side liquidity, internal range liquidity as well. You could look to mark out this minor sell side liquidity. However, I wouldn't really look at this minor sell side liquidity as a point to mark out, as it's one of those liquidity levels that is likely to get ran through, considering that we have within the space of 100 handles a very high probability point of liquidity such as previous week low. So one point of minor buy side liquidity I'd look to mark out would be this previous high. So I've taken a look on the fib tool, and this move that's happened from 7 a.m. towards 8:30 a.m. I would look for this point of minor buy side to get taken, and I would be comfortable looking for shorts in price once this point of buy side has been taken, and we can look to target this point of minor sell side. The reason why I'd mark this point of minor sell side is would be mainly for the fact that we can look to target it for shorts if we get a clean short opportunity. If minor sell side gets taken, that does not mean that in this scenario I would look for an opportunity for longs. I'd only look for an opportunity for longs once previous week low has been taken. Once price takes this minor buy side liquidity, it would have come back to a premium, a lower time frame premium of this range. We have a higher time frame bearish SMT for price, and I can expect price to then draw towards previous week low, and we can look to target that point of minor sell side liquidity. Okay, so taking a look at CPI day, this is on Wednesday the 12th of March, and when CPI actually came out. So CPI always comes out at 8:30 on a Wednesday, and it can come out at different dates of the month, usually on the 12th to the 15th of each month it would look to come out, and it's always at Wednesday at 8:30 a.m. and you can see here the low of CPI would be your data lows and the high would be data highs, and you'd look to mark out these two key liquidity levels inside of the New York AM session, and these are going to be your major draws on liquidity, and you're going to look to mark this out on both NQ and ES. And if price is still inside of the range between data highs and data lows, and not either point of liquidity has been taken on either NQ or ES, then you're simply in range. You're still in range. Price is basically pointless in trading. There's no valid trade to take when you've not taken buy side or sell side liquidity. Okay, so now we're at the New York Open. Let's monitor price to see whether data lows or data highs gets taken, and we can work out an overall bias for where the New York first day macro is likely to draw to. And I'm going to put you guys on a little bit of source here. So whenever a event such as CPI or NFP does come out and you approach the New York AM session, for example, the bullish gap or bearish gap created by CPI or NFP, 90% of the time, price would always look to draw to 50% of the range created inside of this fair value gap. From the low of the wick to the high, this fair value gap, price 90% of the time would draw to 50% of this range created by CPI and NFP. This is a proven fact, and you can backtest this yourself. I would say 89% of the time, price would always, inside of the New York AM session, retrace to 50% of the range created by CPI and NFP. So let's monitor this New York AM session and understand where price is likely to draw to. So far we're still in range. Okay, so as you can see on ES, we've actually taken out data lows and we have a bullish SMT on NQ. NQ did not take data lows, however it took a point of minor sell side. We have a bullish SMT for NQ and ES took out data lows. Therefore, I'm going to be overall bullish on NQ here and more looking for longs on NQ. And if we get a clean long opportunity, then I would actually look to take longs towards data highs, as long as the risk to reward makes sense. But because as of now, if we was to see an opportunity for longs, then we would be very close to the data highs and possibly there'll be no trade there to take. Okay, so as you can see here, we just tapped data lows on NQ and actually left equal data lows. So I'd obviously want to see that get taken out if we was to look for an opportunity for longs. Okay, so that short-term low around data lows has now been taken, and now we're going to look for a clean displacement higher for price. Okay, as you can see here, we have this fair value gap paired with this breaker block on NQ. So this is a bullish unicorn model setup for longs. This is an A+ setup. This is one that you would not want to miss. A very clean setup indeed. ES has actually closed above the bullish breaker as well. So this is still a valid trade to take and correlated between NQ and ES. ES has also created this bullish gap. So you definitely look to take this. The first point of entry would actually be the wick of this bullish breaker. So for this example, I'd set my stop around 35 handles below the bullish breaker, and I would set my TP at the high of these relative equal highs. So as you can see here, we have these relative equal highs on NQ. I expect NQ to draw towards this minor buy side liquidity, and it's a quick 1 to 2 for price. And some of you may be wondering, do I ever take 1-to-1s? I do take 1-to-1s. If they do make a lot of sense to take, then I'm going to take a 1-to-1, but majority of the time, and I'd say 90% of the time, I preferably want to take at least a 1-to-2. Okay, as you can see here, the first presented gap for price is at this point, and this is called a breakaway gap, and price is likely to never draw back to the breakaway gap, and the first point of entry, which is this fair value gap, is likely to be the point of entry you look to enter off. However, in this example, the stop placement is not the best, so I would actually look for an entry on the wick of this breaker in order to have a valid stop. So once price comes back to the wick of this breaker, I'll look to enter long. I'd run my stop in the mid-range of this bullish breaker, and then obviously target that point of relative equal highs. Okay, so price has come down on NQ and almost tapped that bullish first presented fair value gap, but didn't actually give you an entry. And as you can see here, ES tapped the first presented fair value gap, which was paired with that bullish breaker. So it's likely that this trade is not one that you would have taken and you would have missed it, because NQ did not give a valid entry anyway. Okay, so as you can see now, price has almost continued towards our final TP, and it's actually just tapped into the first presented fair value gap inside of macro. Therefore, this trade is no longer valid. So if price does draw towards this bullish breaker for price, we're no longer looking for an entry. It's drawn back to the first presented fair value gap prior to the macro, and it's almost tapped our final TP. So this trade has pretty much already played out, and it's tapped this bearish PD array, and so far it's been respected. Therefore, there's no reason that you should be looking to enter this trade anymore. So you'd have to delete it off and skip it and wait to see if you get any other opportunities. And guys, that is it for episode 2. Hopefully you have more of an overall understanding on the key liquidity levels to mark out during the Asia, London, New York session and the PM session. If you guys are loving this mentorship so far, make sure to drop a like on this video and comment any questions that you guys have. I know I didn't really reply to many comments on the last one, but I'm going to try my best to answer as many of you guys' questions as we go through this mentorship, because I want to understand what you guys are currently struggling with and what you guys need to improve on. So I'll see you guys in episode 3.